Welcome to the current federal tax developments for the week of March the 30th, 2020. Current federal tax developments are brought to you by Kaplan Financial Education and your state societies of CPAs. Well, to say it's been a full week is putting it very mildly. We've had a whole lot going on, including a brand new tax law that was signed into law on Friday. We've also had some continuing developments on due dates for returns this year. So we got a lot to look at and a lot to talk about. So we'll try to key on some of the key things this week. I won't have time to go into deep detail regarding what's happening with regard to the new law. So I'm going to look at it. I'll talk to you about some of the highlights of it. We are doing some sessions on the topic. Other people are doing sessions on this law that will delve a bit deeper, but I can at least give you some of the key issues to focus on now if you're looking at the law. So let's get started with the week because things happened as this week went on. And if you remember, where we were left last week was that essentially we had an extended due date out there for the 1040s and for the first estimate, but a lot of confusion about what else it might apply to and some other information. We also had, still in process, the issues arising related to when the payroll tax credit would begin for the sick leave. We got clarifications on those items this week, along with information regarding this brand new bill. Now, at the same time, we're now seeing the IRS mainly shutting things down. There has been a post there about their People First initiative. They released on their website this week. They're pulling back on certain collection issues, they're pulling back on other items. Apparently most of the IRS now is assigned to working from home to the extent that can happen. So there's lots going on, and we expect to be lots more. So probably by the time you listen to this, we'll have even more stuff that has happened. But let's start out with our first regular development of the week. And we'll talk about this. We talk about Notice 2020-21. This came out on the 27th, Friday. Lots of things came out on Friday. What we had in 2020, what we have in 2021 was we're clarifying. If you remember this mandatory sick pay we talked about earlier that was added by the second coronavirus bill, right? We're on coronavirus bill 3 now. They're already talking about coronavirus bill 4. That mandatory sick pay was going to be offset by a refundable credit against payroll taxes. But the question became, when the law passed, we were told it would begin within 15 days of the enactment date. That meant that we really didn't have an effective date of when these things happen. The Department of Labor earlier posted a notice that told us that they were using April 1st as the effective date. That means April 1st would be the first day that A, the sick leave would be mandated, and B, that you could count any leave you gave as mandated sick leave. So if you gave leave before April 1st, you were not going to be able to count that as part of the 2 weeks, the 10 days, effectively 80 hours of mandated sick leave for a full-time employee. You would have to instead give them a brand new set, right? Because this is in lieu of any other leave they were provided. So if that started April 1st, you might wonder, well, when's the IRS going to start picking up the bill for this? And the IRS provides that the credit will start on the same date. So if you have been paying sick leave before April 1st, that sick leave will not be paid for by the government. However, beginning on April 1st, if you are on one of the mandatory rules, remember we had those 6 categories, some of which are 100%, some of which are 2/3, with the caps of $511 or $200 per day, along with the special paid FMLA leave to basically where you need to be taking care of a child because their school is closed or their daycare is no longer available, which basically seems to be true all around the country at this point. Those rules, that payment for that based on a credit against taxes, that starts again April the 1st. So the IRS provides a credit starts on the same day. There will be no credit for sick pay paid before that date. The practical reason, which really wasn't surprising, I think a lot of us expected this means the IRS has until July to come up with a 941 form that can take this into account. The problem is that if it took effect before March 31st, the 941 that we're going to be filing for April would have to be able to take this into account and handle it. and that involves a rather major reprogramming and processing issue. And as you may understand right now, the IRS is also going to be just as challenged as many other people in trying to manage all this stuff while everybody is working from home. So I would expect that they thought from a practical standpoint, kicking it back is going to work. So that'd be the kickback routine, right? The 2 weeks begin on that date as well. So does the ability to start worrying about the 10-week eventual extra stuff. Now, here's one thing that went on the DOL site, though, late in the week you should be aware of. There was some question if a state orders a, basically a shelter-in-place rule. Was that the type of quarantine or, protective quarantine or stay at home that was covered by action number 1 in the list of the 6 items that would require the paid sick leave? The Department of Labor has taken the position that it is not covered by that, and therefore employers who shut down their business due to this particular issue where there is, let's say we have a business where we have to meet people, right? Let's say something like you're a hairdresser, right? Hairdresser, you can't really do a hairdresser's work over the internet. That's going to be a little difficult to pull off. So working from home without seeing anybody would be difficult. So if your hair salon was shut down, you shut down your hair salon because the governor issued an order for everybody to shelter in place. If that's what's happened, then you're not covered by this. Department of Labor says those employees affected by that should be going over to the unemployment. Unemployment has been changed by the most recent act, the CARES Act, and while we're not going to go through that whole thing, that's where DOL is going. Now there's been some pushback on that. There's been a little discussion. Right now though, it definitely appears that's how it works. Now remember, if the employee can work from home and you've got them working from home and then they come down with COVID-19 or unable to work from home, which by the way, if you get it bad enough, I think there's enough out there that we're aware that if you're one of the unlucky group that gets it not necessarily in hospital, but certainly bad enough that you're not going to be able to continue working on your projects very well, yes, those people should still get their 2 weeks of paid leave. Again, if you're unable to work from home, and so that'll be one of those odd situations. So that would probably still work. But if it's just because there's been a shelter-in-place order and you've got a business, there is no way we can do it if we can't be in the business location, which is true for a lot of services, where the service is not one that can be rendered over the internet, but is a personal type service that requires personal attention. Yeah, that's going to be a little different. Now, this next one, 2020-30, this change is something we're going to discuss next in following this. But the IRS had initially insisted, we got a whole bunch of clarifications that we'll cover here in just a second, regarding what the delay from April 15th to July 15th actually took effect for. And in the initial post that we'll discuss here in just a second that's on the IRS's website, the IRS had indicated that gift tax returns were not going to be extended. So here's the quirk. In recent years, as you're aware, if you file a 4868 to extend your personal income tax return, that also serves to extend the gift tax return. Because of that, very rarely do we ever file the Form 8892, which is the standalone gift tax return extension. Because normally, the returns of people who made taxable gifts tended to be more complicated. And because of that, they tended to get put on extension. And if they're going to be on extension anyway, then the gift tax return came along for the ride. The question we had was, well, now we're treating April 15th income tax returns as being due on July 15th. We're going to file the 4868 if we have to in July. The question is, though, are we already too late on the gift tax return? And the initial IRS position was, yeah, you're too late on the gift tax return. However, they had a change of mind on Friday, and it noticed 2020, in this case, 2020-20, not 30, 2020-20 that was issued on the 27th, they pushed the due date back to July 15th. So we're not going to need to be filing all those 8892s. I know of firms that were ramping up who do a lot of gift tax returns. We're ramping up to have to try to, in essence, find all their gift tax return covered clients, potentially gift tax returns covered clients for last year, and make sure 8892s went out for all of them and get all that ready, basically going through a very similar year-end extension routine that we normally do on April 15th. Now it turns out that one won't be needed. On July 15th, you will still be able to file an extension to October 15th by filing an 8892. So you can still do an 8892 at that date. That will get you the extension all the way to October, assuming that you go for that extension. So we calmed that one down. Now there'll still be other issues and other things. I'm certain we're going to see additional due date changes and items. We're already getting complaints about issues with not-for-profits on May 15th, and that clearly is not yet covered. We had issues with states. States are mainly following the July 15th deadline. The last I heard, we were down to 3 states that hadn't yet announced extensions, and I believe those 3 may probably do so here shortly. But be careful with the states. Some states, like Arizona, my home state, are not extending the first estimate automatically. So you may have an issue where you've got an extension on the 1040 or an extension on the state income tax return, but the first estimate is still due. Why that is true, I think the catch is a lot of states have June 30th year ends, fiscal year ends. A lot of them have constitutional requirements that their budgets must be balanced for the year. And I think they may have discovered that you can play certain accounting gimmicks to make a budget look balanced. But I think they may have had to pull out every stop to make it look balanced by pushing the April 15th dates back, because those are dates where, but probably still it's kind of an even number, at least even. The money comes in there and it's not all refund money, but it's kind of a break even, and you're going to kind of assume that the people with refunds will keep waiting to the very end because they'll procrastinate just like normal, and so will the people with tax due. So that cost may not be as big, but the first estimate is something that's just money and there's no refund. So I have a feeling that some of this is driven by that consideration, that a state feels they can't push that one back because that would put them in violation of their state constitution. Again, speculation, but those June 30 fiscal year ends, that would explain why they would not say, well, wait, we're just talking about kicking it back, and why are we worried about that? Okay, we are. Now, the IRS does have their filing and payment deadline questions and answers up on their website. That went up on the 24th. Now, the last time I checked, I haven't checked in the last 24 hours, but for a while there, it was still showing the gift tax return didn't get extended. As I was pointing out, the IRS was a little behind in updating this page. But this page does clarify a bunch of other returns. And so basically, they tell you first a list of forms covered are found there, and it'll be on the website. The web location is in the materials you can download from our site for today's session. It is a list of form covers. One I've been asked about multiple times is the 1040 NR. The 1040 NR is covered by this. It is in the list of forms. So if you have somebody filing a 1040 NR, that is covered. That's kind of significant. Also significant, the 965H payments. I mentioned that last week, being uncertain whether we get an extension on that. This tells us that yes, the 965H installment payments and Section 59 Cap A BEAT payments for corporations that are due on April the 15th are now extended. The catch was that those letters, at least my client, have gotten those letters like, they got the letter for the new installment agreement, just a few days before this delay was announced initially. And some of them just went out and paid it immediately because their theory was, I don't know that I'll be able to get to the post office, depending upon what type of restrictions are there. So I want to go get this done right now and then not have to worry about it later. So yeah, I got a few of those already. If you've already done it, yeah, they're not sending it back. They did clarify, which was the big issue we had, that you will get a full extension. You can file your 4868 at July 15th. That will still count for an extension to October 15th. It'll be treated as if you filed the 4868 back in April. So right now that would get us an extension to October. The IRS does tell you what's going to happen if your client's already filed their return. They had a withdrawal scheduled for April 15th because you put that in your software. Bad news, that's not going to move on its own. There's no easy way for you to move it. Rather, they have to try to contact the federal government. We'll see how easy that works now, with the federal government kind of pulling back and having more people work from home. But they do have instructions on the website as to how to get that payment delayed. What they're telling you to do right now, if that payment was scheduled by the tax software, you have to call Treasury, cancel the payment. Then if the client still wants the automatic withdrawal, they have to go in on their own to the website for the IRS payment website and arrange that on their own to hit the account on July 15th. That'll take it. We've been told now that the IRS's e-filing systems can now accept July 15th, but now we've got to wait for our software to be updated to allow a July 15th date, because previously that would cause a return to fail e-filing checks. It'd fail e-file, the IRS wouldn't accept it, so your software isn't allowing that entry. Now the software will have to be updated to allow that, and the software still probably has to be waiting for all the states and everything to calm down to update things like instructions. Those are still kind of a mess for most software. The IRS made it very clear the second estimate is not extended. The second estimate is due before the first. The IRS reiterated that on the page. That was what we got last week seemed to indicate would happen, and they're telling us, yep, you're right. We also were told that IRA's due dates for funding an IRA, that does push back to July 15th. That's somewhat important, right? That pushes back to that date. We're also told, though, that we're going to push back the due dates for other things that relate to this, so like things related to 404. 404 deduction payments, that's going to be like funding your profit sharing plan and those sorts of things. That will get you to July 15th as well, and if you file the extension on July 15th, that would get you to the October 15th date for funding the plan. It also counts for health savings accounts and medical savings accounts. Their move goes back to that date. Now, there were a couple of less favorable news items in here. It does not apply to payroll taxes, right, or estate taxes. But it does not, but they also noted if you had a taxpayer, let's say there is a refund due from 2016, you need to file an amended return, or they've just never filed their return. They're going to lose that refund. That date for filing has not been extended by this, so the statute will still die on April the 15th regardless. So if you have somebody who is looking for the statute for April 15th, 2016 to get a refund, that return still needs to go in before April 15th of 2020, or the statute will die and they will lose that refund. That's important. But the gift tax return, that part on the page you can ignore. Now, we're going to go very quickly through the CARES Act, and I'm planning to do a full hour I know I've got that at least in Arizona right now, that we're going to be doing the full hour on it, that will look at these things. May have a couple of others. I think they're scheduled, but I don't have full confirmation yet. So, we may have a couple of others we'll be doing here in the next week, and I think that's the key in the next week, because you kind of need to get on this right away, as a point. So we're going to be looking at this. But this is the Coronavirus Aid, Relief, and Economic Security Act that was signed into law by the President on March the 27th. Get that right. The key takeaway from this thing is the rebates for individuals. That's the one that you're seeing all the coverage of in the press. That's the one that's getting lots of talk. The rebate will be $1,200 for anybody who's not filing a joint return. That's the base rebate. $2,400 for those filing a joint return. As well, if you have a qualifying child who qualifies for the child tax credit, they're cross-referencing the child tax credit, then you will get an additional $500 for each child. What that means is that 17 is still going to be the problem age, right? Once the child gets above age 17, right, has that at this of the year, has that age 17 problem for the child credit, the same problem's going to occur for the issue regarding the $500. You will not get it, so if your child is 17. We're not sure, we talk about the prepayment of this thing, we're not sure what's going to happen if on your 2018 return your child did qualify. On your 19 return, your child does qualify for the child tax credit, but they wouldn't on the 2020 return, because this is technically a 2020 credit that we're getting prepaid based on either our 2019 or 2018 return. Yeah, that's the other quirk in all this. They're prepaying. We've done this before back in 2008. So we're going to prepay the credit. And what we're going to do is we're going to pay the credit based on your 2019 return and just apply that as if the rules for 2020 applied. Why that's important is because this particular credit phases out. By 5% for each dollar that a taxpayer's AGI is in excess of $150,000 for those filing a joint return, $112,500 for those filing head of household, and $75,000 for all other taxpayers. Now, how it phases out depends to a large degree on how many kids you've got, because remember, it's going like a $5, you lose $5 for every 100, so obviously if you have a bigger credit, it takes longer to phase out. But that's going to be important because they're going to make their first guess based on your 19 return, right, if it's been filed and processed. If it's not been processed, they're then going to look to your 18 return. Okay, if you didn't file an 18 return and you haven't filed a 19 return, then if you're getting Social Security or railroad retirement, they'll look to that, what was on your 1099s for that, in order to come up with their computation of what your credit should be. The credit is refundable. And because of that, it means that you don't have to have a tax liability. You'll get the check. Also, that the prepayment you get reduces your credit on the 2020 return, but not below zero. There is no provision in this section. There had been provisions and there had been other rules, but in the final bill, there is no provision in the law that requires you to repay it if you're overpaid based on either your 18 or 19 return, whichever one they used. Now that's brought up some issues, and you'll see some stories right now about, no. Now you got to consider, do I need to run out and get my 19 return filed right away? Well, I think there's a couple of problems with that. First thing is you compare 18, 19, or what if I filed my 19 return, my 18 was better, had lower income, I'd qualify on that, I don't have 19, can we get the 19 return out? Here's the catch. I suspect the speed at which they want to issue these, and the fact the IRS is going to be personnel challenged and have a lot to do, I would not be shocked if that ship has sailed. Whichever return is going to be used for your client is probably already, been determined. We're already set. It's not going to make a difference rushing trying to get these done. Secondly, I think most of us, just won't really have the time to schedule this out, to try to figure out that minority of clients where the 19 return isn't done, the 18 return's been filed, the 19 return isn't done, they're going to phase out, it would be worse, they're in the phase out range, and by the time you determine all that and then figure out, we got to get the return filed, and there's not going to be much time if there's any time left to get it filed. And reality is, I think it's going to be an impossible case. But you are going to see reports about that in the press, so be aware of it right now. Now, taxpayers that don't qualify for this, non-resident aliens do not get it. Anybody who can be claimed as a dependent on another return. That could be significant because let's say that you have your parent living with you and you are claiming them as a dependent. You're not going to get the $500 for grandma, but you're also not going to get, grandma's not going to get $1,000 or $1,200 for grandma either, because that will be kicked out because grandma showed up on your return as a dependent. Yeah, that makes for a quirk. And also estates and trusts. Well, yeah, I kind of understand why somebody who died is not going to get this. So we're going to see how this goes. We do have to have valid ID numbers for the taxpayer, the spouse, and every dependent. There's a special exception if one of the spouses is an armed services member. Then we don't need to necessarily, when we're adopting a child, we don't need to have a valid adoption number. That's what goes on there. Again, the advance credit, as I said, that will be computed. They're going to deposit it in the bank account that apparently was some bank account you authorized to receive a refund or other federal payment on or after January 1st of 2018. So it'll probably be whatever was used for the 1040 last year to deposit the refund, or this year if you use direct deposit. If not, they'll be mailed out. The mailed out ones are going to take longer than the direct deposit. Also, they will look to Social Security's records. If you're a Social Security recipient, it should go to your account based on that. So that one will be fun. They also gave us some special relief for use of retirement funds. You can have the coronavirus related distributions. That's anything in 2020 that comes out. If you either were diagnosed with coronavirus or related virus, your spouse or your dependent was, or you were economically affected. Well, I think that last category is going to cover about everybody, right? You can take up to $100,000 distribution. It will be taxable. It would be taxed over 3 years, though. 1/3 of it taxed in 2020, 1/3 in 21, 1/3 in 22, unless you elect to have it taxed in 2020 in whole. As well, you will have 3 years from the date of distribution to put the money back in. That would be treated as a rollover distribution, and presumably you'd be able to go back and get any taxes you had paid related to that part of the distribution back by doing so. So you can use it as kind of a quasi 3-year loan. That's something they borrowed from, you may remember, from the birth of a child rule that was in the Secure Act. Kind of the same thing, except this time they realized you might as well put a 3-year limit on this thing, because after that we're outside statute and things get a little weird. The birth of a child one didn't have that. There's a list of plan types there's a list of plan types that were in there. They're basically the standard employer retirement plans, 403Bs, 401, standard employer retirement plans under 401A, which include 401K plans, profit sharing plans. The federal government's thrift saving plan works for this. IRAs work as well. So all of those are covered. As well, the maximum loan from a qualified plan, instead of being $50,000 or 1/2 of the vested deferred benefit, is now going to be raised temporarily to $100,000 or 100% of the vested deferred benefit. As well, there will be, for any currently existing loans, there will be a 1-year deferral on payment is available, and that'll have a knock-on effect too. We're just going to take that year out. We'll ignore that year for the 5-year limit. So we'll have all of these things happening with plans. So if you have plan loans, there are some issues. Plan amendments eventually have to be adopted for this. Tentatively, it'd be for the first plan year on or after January 1st, 2022 to allow for these things. You're allowed to operate the plan as if it's amended now, but you need to get the amendment in in that 2022 plan year or a later date if Treasury allows for it. Other big change, we're waiving required minimum distributions for this year. That's a big one, including if somebody had an RMD. Let's say the required beginning date is April 1st, coming up here very shortly, of 2020. They will not have to take that money out, right? If they took it out in 19, they can't put it back. But if they held it and they were going to take it out April 1st of this year, they can still hold that money. They will not need to take that distribution. The same will be true about any 2020 required distribution, regardless of what your age is going through this. The real question becomes, will the IRS allow, let's say, I'm 75, I took my $100,000 out this year early. Will I be allowed to put $100,000 back into the IRA, assuming I still have the $100,000 to put back in? Will I be able to put it back in the account? Well, if you're within the 60 days, you probably can, but what if you're outside the 60 days? We'll see if the IRS gives us some relief on that, but that's not covered by the bill. They didn't grant that as part of the bill. So that's not there. We have an above-the-line deduction for charitable contributions for 2020 up to $300 if you do not itemize. If you do itemize, we're going to effectively change the percentage limit for charitable contributions to 100% of AGI or 25% of taxable income for a C corporation. There are some limitations that you can't use this to put money into a 501(a)(3) supporting organization, private foundation, or for the establishment of a new or maintenance of an existing donor advised fund. The money can't go into those to get to the max limit above the 50% or 60% cash limit that we have now. Also, the special limitations on donations of food inventories by a C corporation used to be limited to 15% taxable income, will be limited to this year to 25% taxable income. And the final issue is there is an ability for an employer to make up to $5,250 payment on a student loan for an employee, not have that includable in income. But be careful here. That's not a blanket allowance. It rather treats it as a tuition payment program under 127. As you may remember, those have significant restrictions on benefits that could go to anybody who is an owner or is a dependent of an owner of a 5% of the organization. So for small companies, this is not going to allow you to pay for your child's, let's say student loan. You're not going to be able to wipe that out or do things like that. It'll have very high restrictions on what can be done. So you need to be careful. And also, if somebody's already received the tuition payment, $5,250 is going to be reduced. So you can't pay their student loan if you already paid this much toward tuition. So if you're looking at that one, get into 127 before you take much look at it. Also part of this, one key issue that's part of this you have to understand, and I am not an expert in this by any means, but there is a combination payroll protection program loan and the ability to have that debt canceled if certain things happen. This is an SBA loan. The money will be loaned by the bank, so you'll still apply to your bank for this under an SBA program. Details of it, I believe the U.S. Chamber of Commerce has a pretty good summary that appears to be correct. Everything appears to be at this point because we just got this Friday and we don't have guidance yet for applying for this loan. It is a different thing than the disaster loan that we first made available to people in areas affected by COVID-19. But if your clients applied for one of those, they are supposed to be able to refinance that into this type of loan with, again, the possible forgiveness of debt. The maximum amount of the loan is based on effectively 2.5 months worth of payroll expenses. Self-employed income will count for this purpose as well, so you can count those sorts of things in your 2.5 months. Various other payroll-related expenses like healthcare, retirement plan monies. It's based on your average wages for the 1 year before you get this loan, but you have to exclude any employee who had over $100,000 of income in this number. But you get a loan up to 2.5%, 2.5 months. 2.5 times, so 2.5 months worth of payroll essentially based on your average for last year. And if you spend it during the 8 weeks after you get the money on the payroll expenses plus qualifying mortgage payments, which includes interest but not principal, or you spend it on qualified rent, then you may qualify for loan forgiveness, but there are special rules there that it's going to be reduce your forgiveness opportunities if you have cut the number of employees or if you have reduced an employee's salary by more than 25%. Again, there's supposed to be money to keep the economy running, to go into payroll. So if you take this money out and you don't pay it out as payroll, it will be a standard loan. If you take it out and you keep people on the payroll, then it may be forgiven. It will convert to a grant. So if you use it for the purposes they want you to use it for, it becomes a grant. If you don't use it for appropriate purposes or you don't keep people on the payroll, you lose part of this. Now, why am I mentioning this in a tax program? Because here's the catch. You cannot get two tax benefits that are in this program if, number one, if you've got any loan under this program, you cannot make use of what's going to be the credit, which is called the worker retention credit, right? Employee retention credit for employers subject to closure to COVID-19. You won't be able to get that credit. Otherwise, that credit is going to be for 50% of wages if you maintain you maintain employment, right? And you've got this COVID-19, you got this issue, you were shut down, had to close because of COVID-19, or you had a major drop in revenue, a 50% drop in revenue in a quarter, and for that quarter until the quarter at which your revenue goes to at least 80% of the prior year, you'll get this credit equal to 50% of qualified wages. Now, it's wages where, it's going to look at times you're not providing services if you have more than 100 employees, and then you're either in the period where you're shut down or you're in the period where, your sales are way down. Or if you're over 100 employees, then anybody, including people who are still providing services, their hours should count for this purpose. Now, again, here's the catch. You can't do this if you are going to be receiving, if you get a loan under the SBA program, apparently in this case, even if not canceled. Number two, you also cannot claim any of the jobs credits type things, the credits listed in Section 280 Cap CA, which are mainly like all the job style credits. You can't take any of those credits on these wages. So it's a choice. As well, you probably heard a lot about the fact that the employer portion of payroll taxes for the rest of the year, beginning with earnings on or after Friday, you can go ahead and you can delay that payment, not pay it at all this year, and take all your employment taxes, so it'd be your employer FICA, take your employer FICA for the rest of this year and pay it 1/2 by December 31st of 2021, 1/2 by December 31st of 2022. But this is also a program that apparently you can borrow under the Payroll Protection Program loan, but you're not allowed. But if you take any forgiveness of debt under that program, then you're not allowed to use this deferral. Oh, by the way, and that cancellation of debt, one other big thing. It is not taxable income, and it's not being kicked out under Section 108, so there is no apparent reduction of attributes, right? You're not going to lose part of your NOL. You apparently will get to deduct the wages you paid. So yeah, this is a complex area. Advising here is interesting because of the interaction between the four items: the payroll protection program loans, the potential cancellation of indebtedness on those loans, the payroll tax credit for retaining workers, and the deferral of paying payroll taxes. Those are all interconnected. And it's really important you have to understand that interconnectedness before you start advising clients on doing things. Number of things, some things that in TCJ, then I decide maybe we shouldn't have done them since, because we hadn't planned for, COVID-19 shut down the economy type of situation. So we are going to get back net operating loss carrybacks. They will come back in, so we'll get them for 18, 19, and 20. They'll be 5-year carrybacks. You can still elect to carry the whole thing forward, so we're going to see what IRS does about 18 returns and 19 returns already filed. 18 returns mainly will be our problem because obviously you're too late to opt out unless you were a farmer, right, or a insurance company. And if you were a farmer insurance company opted out, maybe you don't want to anymore. We have to see if you go back 5 years. You thought you were opting out of 2. So we'll see what they do about that year. Guidance obviously is going to have to come. But you'll be able to carry back 5 years. There are special rules because in the middle of that is 2017, which was the year if your client had 965. Remember the 965 installment payments we talked about earlier? Yeah, there's special rules in here to kind of keep from fouling that up on the way through. So there's some deemed elections for 965 taxes or just a straight election to skip the 965 year as part of your carryback and use other things, right? We can just skip that year. So, but the NOL rules are in. They're only in for 2 years. And yeah, no 80% of taxable income limitation. Now, all of this comes back next year, right? The TCJ stuff comes back next year, but right now it's just this way. We also have a temporary removal and actually retroactive removal of the 461L loss rule. Remember, that was when you couldn't have losses if you weren't a corporation in excess of $100,000. Individuals going to be stuck with that, $250,000 if married filing joint. It would be carried forward as an NOL. Now they're saying don't worry about that for 18 and 19. We're just going to ignore it. But when it comes back in 21, remember that technical correction question about whether wages were business income? Wages are business income. Yeah, that's going to be added back into the law. When it comes back in 21, that will make this a much nastier provision. When they initially enacted it, they meant for them not to be in business income, but they didn't say so. But that's business income. Now they're saying, yeah, you ignore that. Wages are not considered business income. If you're a C corporation, has excess minimum tax, and we're going to get that, over a few years under the TCJ. Now you can go back and take it either 50% in 18, 50% in 19, or you can take the whole thing in 18. So if you had a minimum tax credit and last year you had excess minimum tax credit, you can amend the C Corp return and now get back all of that. That's what they're going to allow you to do under this provision. 163J, we hadn't even gotten the final regs yet, and we're changing it. 163J's limitations will be changed. For tax years beginning in 19 and 20, the business interest limitation goes from 30% to 50%, and this change affects everybody except partnerships. Why not partnerships? Well, we got a problem. For years beginning in 19, partnerships will not get the 50%. Why not? Remember the Bipartisan Budget Act audit rules? Yeah, that'd be a problem because there'd be no way. Remember, we can't really amend those prior returns. And so that means the 19 return's already been filed. We can't go back and fix it. So what's going to happen instead for partnerships is that we're going to make special rules that for any excess business interest that came out on the 19 return from a partnership, 50% of that next year will be treated as business interest not subject to 163J limitation on their 2020 return, and the other 50% will be treated like the normal carryover. Their theory is that approximates giving the partnerships the 50% instead of the 30%. Also, because if you have a loss this year, you lose a ton of money. 50% of nothing is not more than 30% of nothing. You're going to be allowed to base your 50% limitation on either 20 or 19's taxable income, 20 or 19's income. So you can do your limitation based on 19 or 20. That'll be part of the rules for everybody in that particular realm. Okay. We did get the fix for qualified improvement property, retroactive. So qualified improvement property now is 15-year property, qualifies for bonus, and we treat this as if it was always in the law, which was always intended to be in the law. How we're going to handle amended returns, if it's going to be a simpler way to get the money back, that's, again, to be determined. Remember, this thing just barely got signed on Friday afternoon. I think it was signed about 4:20 p.m. Eastern time on Friday afternoon, so there has not been a lot of time to react and get guidance out on this, so we don't see a lot happening there. If you have any clients who are distillers and are using their distilled liquor now to produce hand sanitizers, they get out of an excise tax. Probably doesn't affect many of our clients, but hey, what the heck. Oh, and buried elsewhere. Now, this we have to look deep in the Act because this is not in the tax provision, but in Section 3702, added to items that can be paid out of an HSA, MSA, or FSA are menstrual care products. So that's a new add, and that's basically permanent, and it begins as of the beginning of 2020. Now that's buried in a whole different section of the Act, right? The Act is 800 and some pages long, at least the version that got put up by the Senate or got put up by Congress on their site, the version they passed. When we get this reprinted, it'll probably come down to a much more manageable number of pages, but it's still there. So that one's buried in there as well. Now there are a whole bunch of other provisions in there. The change unemployment tax, the change not unemployment tax, but unemployment rules. That change other rules that have various benefits in it. We're not talking about any of those. This is just the quick. If you've not looked at this act, you need to look at it. Hint, how do you check an act like this? Let's talk about how you read a bill. When you have an act like this, they're going to keep telling you what they're changing. Okay? Now, if you're lucky, I noticed the tax analyst already had their copy of the code updated for these changes. So these changes are already in there. So it's already been incorporated in the code text. So that's good news. If not, you got to realize, like if you're using the online version for free from Cornell University, you got to realize that one's probably not going to be updated right away. It's, I have a feeling they got a few problems too. So that'll probably take a little while to get updated. So what you do though is you take the bill, you look at what's changing. The other issue is there's a lot of items in this bill that have non-codified changes. They do not put things in the Internal Revenue Code. It is law that exists in the bill only. So you have to understand that. And lots of times these sections will still reference things in the code. So when you're reading this bill, what I always do is I have the bill open in Acrobat on one screen, and I have the Internal Revenue Code on the other screen. And I keep putting in, anytime a code section is cross-referenced, I put in the code section, what the heck does this refer to? Because when they give you the list of plans that you can take the $100,000 out of, they just give you a list of code sections. And I mean, some of them are pretty obvious to recognize, but some of them are a little bit tougher. And so you have to go back and like double check. Sometimes they'll also make references outside the Internal Revenue Code. That's when something like Cornell's Legal Information Institute site with U.S. Code is helpful, even if it's not totally updated to the instant, because you can put there, a section, something, let's say it's in Title 5 of the U.S. Code, you can put that citation in and get that and figure out what are they referring to. So yes, you need to spend some time looking at that. You've got to be very, very careful on talking to clients about the loans, the payroll tax credits, and remember, these are all completely intertwined. If you're going to use one, you're going to shut down using another. So be very careful looking at that when you're advising clients. Okay. Like I said, CPE for 2020 is going to be kind of interesting. As I remember Tony Nitty had a comment on Twitter saying, well, this solved the problem is going to be anything to talk about in tax updates this year. Yeah, we pretty much solved that by now. We got lots of things to talk about in the tax update for the year. We got tons of stuff now. So yeah, we thought it's going to be kind of a down, quiet year. Yeah, it's not going to be. Make sure you check with that. Check with your states. There are a lot of state societies. Like I said, I'm going to be doing some, and I'm not the only person doing them. Other people are doing these sessions. Probably makes sense to check with your state society, see what they're offering. Some of the states are offering free sessions. Some of them are offering sessions at a reduced price. Various ways you can get in. So take a look at your state societies. Make use of that. If you're not a CPA, let's say you're an EA, then you might take a look at the fact I'm sure some of the EA societies may be offering some options on this. So keep it open, but also take a look at your CPA. Remember, CPE is still coming this year. Now, figure a lot of it's going to be online. A lot of it, the live stuff will become webinars. And for some of us, that's pretty straightforward. We've been doing that in Arizona for a long time. For some of you, that'll be a new thing. But we'll survive through it. We'll figure out how that all works. We can get yourself your CPE, and there's going to be a lot of things you need to know. Again, like as often happens, much of this relief is being implemented through tax policy and through tax changes, and that means there's lots that we need to know to help clients implement this. So be sure to take a look at what's there. This has been the current federal tax developments for the week of March 30th, 2020. I'll try to post additional updates as I get a chance during the week online at currentfederaltaxdevelopments.com. So if we have new things, I'll try to post some things up there. You also, if you have questions or comments, you can email me at zollers@currentfederaltaxdevelopments.com. I will be following some of the things on the discussion groups. I've been bouncing around all kinds of places. I'm not able to follow all of them as much as I'd like right now because I had a lot of things to do, including prepping up for courses on 2 laws in 2 weeks. So yeah, we've had a little fun with this. But I will try to check in some on the subreddit of /r/taxpros. I also look into Tax Talk, Cal CPA's discussion forums that's available to CPAs across the nation. I am also on the Connect sites and take a look at Connect postings for Arizona, New Jersey, and Minnesota. Arizona and New Jersey specifically have had a lot of discussion related to some of these issues and things that are impacting the local areas. That's a great place to go look for things. Let's say your state has a shelter-in-place ruling. How does that affect you? How does that affect your CPA firm? What are you supposed to be doing? How does it affect your clients? All of those kind of discussions are found there. And what your state is doing as far as delayed due dates, that's also a great place to find it. So check in there. And we probably could use with a calm week on the tax front. Not sure we're going to get our wish in that area. But in any event, I'll check back in if we have things, which I expect we will. We'll discuss them next week on the update. But otherwise, guys, keep safe. Keep your head up. And we'll get back to you next week to see what's happening in the area of federal taxes.